Let's talk about one area of the market that has maybe not acted like many thought it would or should or could the last couple of months, and that is interest rates. Because normally, when the Federal Reserve embarks on a rate-cutting cycle, like the one that began with that half-point cut in September, interest rates, the bond market, tend to go down with it, with the hope being that the extra money will then flow into the economy. But this time around, that did not happen. In fact, rates have really gone up. Look at the 10-year bond yield. It went from 3.64%. That was the week of the first rate cut back in September, to now about 4.58, almost 4.6%. The 2-year, 3.57 to 4.3. So why aren't yields moving lower? Well, one of the answers could lie in what they call the productivity numbers, some of that data that all kind of goes into the goulash that the Federal Reserve looks at. Let's try to make sense of all this and bring in CNBC's senior economics reporter. You did not have a goulash reference on your bingo card for today, Steve, but hopefully it made some sense.
No, goulash is an official economic term, as you know, Brian. So that works perfectly. Listen, here's the deal. The U.S. has experienced a productivity boom. That's a good thing, but it also presents Fed Chair Jay Powell and the Fed with one of its great challenges for 2025 and how to steer monetary policy through it. Productivity, it's averaged 2.6% over the past 6 quarters, a turnaround from negative numbers that came after the pandemic. It had averaged 1.5% from the great financial crisis to the pandemic. And this effect, these high numbers you see, is likely before any impact from artificial intelligence. Even a full or a half a point extra productivity growth, that's a big deal. Raising how fast the economy can grow without creating inflation. Investors, well, you got to figure out how to invest in it. The Fed has to figure out if it's real. Now, Fed Chair Jay Powell in November was skeptical it would last, but hopeful because it has actually been around for a while.
The lure on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years.
Back in 1996, then Fed Chair Alan Greenspan famously saw productivity even when it wasn't in the data. With the economy running hot and threatening inflation, Greenspan held the line on interest rates even while colleagues urged a rate hike. He was right, though he did question the valuation that was placed on it by the stock market. So the question for the Fed right now is it a short-term or lasting episode? Will AI, Trump tax cuts, and deregulation perhaps push productivity up even further? Could tariffs and deportations help derail it? And, of course, how does monetary policy react? Well, higher productivity means Powell can let the economy run somewhat hotter like Greenspan did in the 90s. But it could also mean a higher terminal funds rate, maybe reflected in some of the yields right now, because demand for capital is higher when investments have higher rates of return from productivity. Guys?
You mentioned it briefly, but I do wonder, Steve, how AI feeds into this equation and when.
Well, most of the people that are writing about what we're going through right now, Sarah, are not seeing it. It's a little bit early days. What they might be seeing, though, is the capital demand for AI. I don't know if you guys you follow these headlines. So-and-so is going to invest $1 billion here, $2 billion here. What was Brian talking about earlier, in the last hour, that you can't imagine the amount of capital? That's really part of what's driving rates right now. Plus, the government is borrowing a lot. So you've got this conflict here, both the government and the private sector borrowing a lot. I think AI could be still a few years off. What I think we're seeing right now, Sarah, are sort of post-pandemic effects where one of the things in the literature is people got into jobs that they were better suited for with all the changing that was going on out there. You had companies that had to do without workers, so they figured out new, efficient, more productive ways to get the job done when they had big deficits of labor.
Right. No, they're doing more. They did more with less.
Yeah.
They were definitely more efficient. Steve, thank you. It's a really interesting conversation, which we will continue.